Well, hi everyone, and welcome to the Buffett and Beyond Research Stock of the Week, and we're looking at Texas Roadhouse. You're going to be surprised at this stock, folks, and you know what? You all buy this stock, you hear? You didn't know I could speak Texas language, did you? But anyway, now you know. And remember, folks, if you want to walk on the beach like Jimmy Buffett used to do, then you've got to learn how to invest even better than Warren Buffett does now. And speaking about Texas, yeah, Jimmy Buffett played in Galveston, Texas on the beach there. So just make believe this is not Florida. This is Galveston Beach. And let's look at Texas Roadhouse. Well, it operates 3 moderately priced full-service restaurant chains. Now, before I go on, I just want to say we were all wondering about where the people are going because restaurants have raised their prices so much and people think they've raised the prices a little bit out of sight. So where are they going? Are they going to McDonald's? Are they going to Wendy's? Well, we're going to take a look. But let's talk about Texas Roadhouse because the Longhorn Steakhouse, Outback, and Applebee's are all part of the Texas Roadhouse group. Now, the standout with this company is traffic. There's that word right there, folks. Customer count has increased for 5 consecutive quarters. So now does that start to make you think that, okay, the people are going from the high-priced restaurants and they're saying they're not giving us the food at that high price, or they're not giving us the good food for that high of a price. So here they go to Texas Roadhouse type of stocks and Applebee's. And boy, we just saw an ad on TV on Applebee's. I wanted to eat the TV screen, I'll tell you. So the advertisement is good. But let's come back down here. Now with their restaurants, with their group of restaurants, they offer an assortment of specialty seasoned and aged steaks. And boy, folks, if you ever had aged steaks and you like steaks, you want aged steaks. Yeah, and they're hand cut daily on the premises, cooked to order. Chain offers ribs, fish, chicken, vegetable plates. 709 restaurants in 49 states and 10 foreign countries, including 566 company-owned and 95 franchise locations. So they're operating on both ends there, operating under the Texas Roadhouse banner. And they also operate 41 Bubba's, 33 sports bars, and 7 Jaggers. Now, I don't know what a Jagger is, but if it's anything like the rest of Texas Roadhouse, they're running them very, very well. Employ 82,000 people. All right, now let's look at the numbers. The blue lines are the average stock out there. By average, we're talking about the S&P 500. And don't forget, 96% of professional money managers who manage the publicly traded mutual funds, 96% cannot perform as well as the average stock in the S&P 500. So we compare everything to the S&P 500 because we want to always outperform the S&P 500, and because we do, we are ahead of 96% of the professional portfolio managers out there, and we think we have the absolute best track record out there, but we're leaving room for comparison. So anyway, let's look at the Texas Roadhouse. They have a clean surplus return on equity. Think about your bank account when you talk about return on equity. Do you want to invest your money in a bank that's paying you 13.5% or a bank that's paying you 26%? Big difference. So yes, Texas Roadhouse is in green. Now, when it comes to net income, how much they bring into the bottom line, Texas Roadhouse is bringing more to the bottom line than the average stock out there. But now here's a very, very important point. The revenue is twice as much as the average stock, a little bit more than twice as much. And that's what we look at, because as long as that revenue is coming in, and that's what they do, that's what they're good at, they bring it to the bottom line. And in this case, there's room to bring even more to the bottom line. So they're doing very, very well out there, folks. Now, let's look at some numbers, and I want to show you here. This is a little complicated, so just bear with me. Back here, 2020, yeah, that was COVID. What'd they do? What did the governments do in most localities? They just shut down the restaurants, or at least the restaurants that we're familiar with. So the company was making $2.46 a share in 2019. Then it dropped all the way to 45 cents. Then in 2021, up to $3.50, and it's been rising ever since. That clean surplus return on equity, to get into our growth portfolio, well, don't forget the average stock has a 13% return on equity out there. To get into our growth portfolio, we want to see 20% or above. And what's Texas Roadhouse doing? They're averaging 26% up here now. And you notice this ROE come all the way down here, and that's why I gave you so many numbers. They were rising. Then we had COVID, and then they really started coming on strong, and it's been rising ever since. That is a good sign, folks. The market loves a clean surplus ROE that is growing. Why? Because the clean surplus return on equity that is growing means that the earnings of the company are growing at an increasing rate. Very, very important. They call that acceleration, of course, and that's what the market looks for. The only thing that we don't care about this stock is the retention rate around 56%. We like to see a higher retention rate because retention rate is how much money the company is putting back into itself in order to grow. And for a real good growth stock, we want to see a higher retention rate, like 100%, which means they're really growing fast. But this company is above 50%, doing quite well, and it's definitely going to replace at least one of the stocks in our portfolios. And we're not telling you which one right now because we're just not sure, but we will know by next week. Now, net income growth, the average, well, we just went over this, 15% above the average. Dividend growth rate is very, very nice. Now, come down here, 20 and 21. We excluded these numbers because they were so far off, because back in here, we remember 2019, we went from $2.46 down to 45 cents, then back up to $3.50, been rising ever since. But we're coming back to these numbers, and we'll show you why. Years to pay debt. Let's jump over here. Years to pay debt is nothing. And this is Buffett's rule of thumb. He says if a company takes all the money it's making, how many years will it take to pay off its debt? Well, folks, this company is one of the few companies out there in the world that has no debt. And boy, that's pretty nice when you're operating with no debt. You don't have to worry about interest rates. All right, now, this is what I want to show you. For over 5 years, what has been the best performing company in the restaurant business? We're looking over here. We're looking at McDonald's. We're looking at Starbucks. We're looking at Yum. We're looking at Papa John's. We're looking at Chipotle's and Texas Roadhouse. So when we come over here, this black line is, and I say black because we have two black lines. One's blacker than the other. This is the S&P 500. Now, what two stocks are doing better than the S&P 500 out of this group that I just mentioned to you? Yeah, Chipotle, and that's already in our portfolio and doing very, very well. But what's the second stock down here? Yeah, Texas Roadhouse. These are the only two stocks in the restaurant business that we follow that are outperforming the S&P 500. Now, what are these stocks down here that are underperforming? Drastically, I would say. Well, this other black line, it's almost a gray line, is McDonald's. McDonald's is underperforming by 60-70% the S&P 500 over 5 years. Then down here we have Yum Brands performing about as bad as McDonald's, and then we have Domino's down here. Well, I should say this is Papa John's down here, and the yellow line is Starbucks. And folks, Starbucks is also in our dividend and growth portfolio, not in our growth portfolio, but the dividend portfolio. And yeah, you might have an idea of what we will be replacing Starbucks with. What is this company up here again? Texas Roadhouse. Yes, sir, folks. We are looking at a replacement here. Now, let's look at 1 year Texas Roadhouse. Underperformed the S&P 500 for a little while in there, and then all of a sudden the earnings came out because people were afraid that the earnings were going to go down just like, or do not as well as a McDonald's, like a Domino's, like a Papa John's, like a Dunkin' Donuts. And that's why this fell in here, because it was falling with the rest of the stocks. And then all of a sudden they came out with numbers that were even better than expected, and there you go, outperforming by more than double the S&P 500 over the past 1 year. And of course, over the past 5 years, it's up almost 3 times that of the S&P 500. So when you look at stocks that you want to put in your portfolio in order to outperform the S&P 500 and thus outperform 96% of the money managers out there, yeah, maybe a stock like Texas Roadhouse is one to put into the portfolio. And let's go back to the other one. Yeah, this blue line, okay, this is Texas Roadhouse right here. This blue line is Chipotle's, which is already in our growth portfolio, and you can see why we outperformed the S&P 500. Don't forget, last year for 2023, the S&P was up. We were coming out of a recession type of market. The S&P was up about 22%. Our growth portfolio was up 52%, 2.5 times that of the average stock out there, which 96% of the professional money managers cannot outperform. So that's the kind of stock we want in our portfolio. These two right here, folks. Yes, indeed. And here's all the ones that you heard of. We just went over these. We're looking at Pizza Hut. We're looking at Domino's. We're looking at Yum Brands. We're looking at McDonald's, folks. They're all underperforming the S&P 500. We don't want them in our portfolio because rather than invest in those stocks, you might as well invest in the S&P 500. And if you don't invest in the S&P 500 and want to beat it, you have to put stocks in your portfolio that outperform the S&P 500. It's that simple, folks. And we want to look at one more thing in here. This was COVID in here. Now, this is Texas Roadhouse, and you can see that it fell during COVID with the rest of the market. And if we say this stock averaged, about 70%, even at the top, 80% right toward the end of the year, and now it's double that price. And then we look at the earnings, and let's go right there. We look at the earnings in 2020, 45 cents, but by the end of COVID, we were starting to project next year's, which would have been 2021 earnings, and now the stock is making twice as much as it did, more than twice as much than it did in 2020. And when this is 2020 in here, and then when we can say that this stock is at the least, fairly priced because it has more than doubled its earnings, and we think it has room to run, folks. And so this is a stock that keeps making money at a higher rate. That means it's making more money. That we talked about the accelerating return on equity. We think this stock is just going to keep going and outperform the S&P 500 going into the future. So, folks, we had a great week this week. The market's doing just what we wanted to do, and that is go up. So you go out there over this weekend, go to the beach, walk on the golf course, walk down to the park. Keep your mind off the stock market because guess what? It'll be here next week. And, folks, we'll be right here with you. And remember, if you want to live on this beach like Jimmy Buffett once did, then you've got to learn how to invest even better than Warren Buffett does now. All right, folks, see you next time.